and they do market updates and things like that. So if you're here for the first time, we've never met. Nice to meet you. My name's Sunil. I'm a buy and hold property investor, um, and that's what I've been doing for many, many years. I've got properties here in Sittingbourne, in some in Dover. These are in Stoke-on-Trent as well, little terraces, and then I've got some commercial, but not big commercial places. I've got some big commercial, but this one here is a little shop in Tenham, which is like 6-7 miles down the road, and real great. It's a little shop. I think we bought for about 33,000. We've now got planning to go on top um, for a one-bedroom apartment, and then in the back there's a garage as well, which can be turned into an office. So yeah, basic. The properties, it's core 2-3 bedrooms. Some are ones, some are fours, but mainly the cores are twos and threes. And on that, I've built a big business, reasonable sized business, doing simple buy to lets, and then building on top of that. I've built onto, then done some commercial conversions, some development, some planning gains, and all of those. But it's the buy to let properties which are real key to our business. Um, so this presentation, as I say, is from, just go back a slide. This presentation we've got from Rightmove this week. So this is their latest update, and there are quite a few slides. But if you need to go through anything or have any questions, then happy to answer those as well as best I can. So they're saying that house price inflation has slowed down, and the average house price inflation has slowed down as supply expands, and average house prices is 1.6 up over a 12-month period from March to March. So the average price of a house is 268,000 across the country, and that has gone up since last year. And you can see this graph that it's gone up, and it looks quite a dramatic increase, but it's 4,000 over a period of a year. If you've got a big portfolio, of course, that every £4,000 that's gone up adds to your bottom line. Buy demand was running about 10% over the last year, and that continues into the earlier months of 25. So 10% running supply and demand, which means that people are still coming in. We've got lots of properties coming on. We have seen a shift from buy-to-let landlords as well wanting to exit the market. So that's something that we've seen, and then we're now offering that out to other investors. So we've got one that's come on today from an investor that's we've managed her properties for years, and she now has equity in that property, wants to move on with life, and she's then moving forward. So we're looking for investors of that property. Sales agreed held about 6% above last year. So sales agreed and completed. Some sales fall through, as we know. So a lot of sales fall through. There were 15% more houses listed for sales compared to the same time last year. So more property, more stock is coming to the market. Do you think that's good by a show of hands, or do you think having more stock on the market is going to be good for investors?
Yeah.
Yeah. Yeah. More stock means you've got more choice. Maybe the prices have drop a little bit. People need to move, etc. So 15% more stock listed. It may be that they didn't clarify that as investment stock, but there may be landlords coming out of the market there. But certainly people are finding confident that they're listing their properties and they are moving either to bigger properties or downsizing, or continue to do what people do when they move, divorce, etc. The average estate agent is listing 34 homes for sale, and you can see the graph there that's up on the previous years. So there are lots of competition with estate agencies. That's the market we're in, but they're saying that the average estate agent is listing 34. We know in our area that we have a lot of competition, and one of the market leaders has been here for many years, and they're listing many more than us, and we're probably 15 properties for sale, which is good because then we can actually service them really well on a personal service level. So that's our unique selling point, that we don't have we will service your sale from beginning to end and not pass it to third parties, which the bigger agents do, because once they've got the sale in, they've marketed it, then the progression goes to somebody else, and then they lose contact with the person who they had original contact with. House prices is losing momentum as seasonal factors and economic growth, uncertainty tilts the demand for buyers, cools down for buyers. So they're saying that uncertainty cools down buyer demand. So although there's more stock, it seems like buyer demand has gone down. I don't know if you've seen that in your area, but interest rates have also dropped, which is certainly going to help to reverse that trend. More houses for sales, boosting choice and keeping house prices in check. So buyer demand weakens, but affordability boosts likely. It's a bit wordy, but it's saying, yeah, that there is still opportunities out there. That's the main thing. House price inflation is slowing down further in the coming months. So prices are going to be slowing down going forward. Sales agreement continue to increase. The sales are agreed is different to sales completed, of course, and this is where sales will fall through if it's been incorrectly priced, or if the sale isn't correct. Then somebody like John Evaluation comes along and he says, yeah, the valuation isn't quite right, and we do see sales fall through. And we have seen sales fall through, even though we try hard to keep those sales moving forward. If somebody in the chain drops out, then that can be a major problem. So, yeah, so what do you see as the opportunity there? Sales agree will continue to increase, but what do you see when a sale's falling out of bed? What would you say the opportunities are, Rick?
I think there's an opportunity there to put in an offer at a level where it works for you, rather than wording it as a cheeky offer, um, and pitching that and presenting that in a way that is, depending on the need of the vendor. Obviously, in your last meeting last week, Pattinson's were there. Certain vendors need a quick sale to move on to their own personal circumstances. If you can find the right vendor that has that urgency that they need to get a shot of that asset, then there could be a bargain to be grabbed in the right locations. But I think, coupled with that, there was a lot of a rush when the stamp duty rules were changing at the end of March. Then everyone sort of panicked because they weren't going to hit that. So a few sales fell out of bed. But I think the dust has settled from that, I would say. So now it's kind of business as usual again, and the market's sort of settling around where it should be, generally speaking. So we've seen the asking prices soften a little bit, and we've seen some properties sticking around a bit longer than we have done historically. And I think there's a few good things for investors to bear in mind there. That obviously mortgage rates, as Wayne was saying from DMI, I don't know if he's on tonight, but the rates are changing quite a bit at the moment. I've just had a look at 4 or 5 refinances on some of my stuff today, and there's better rates than when I was looking just 2, 3 weeks ago. So it's worth reviewing with your broker on a regular basis if you've got stuff that is up for refinance, because there's some good products coming to the market at the moment.
Yeah, no, Rick, thank you. Yeah, Wayne will be on later. He's just running a little bit late, but he will be on later. But good point. Thank you. Um, so we're expecting lower base rates. So at the moment, I've just come out. I know I've got 3 fixed rates which end in July. I've spoken to the lender, Saffron, and said, "What is your fixed rate for the next 5 years?" So they've given me that rate, and they said, "When you send back the forms, we will activate that." So I've held off activating the forms because I'm hoping that their rates will drop, and I'll go back to them and get a lower rate, because I'm going to be tied in for 5 years. They've had 2 rate drops. Zoopla, who's got who's got some really good information, and they've got market-led data, of course, as well as what the bank's doing. That they're in touch with everybody. If they're saying that yes, interest rates are looking to drop a little bit more, then I'll wait until the last minute before I press the button on the rates that I get. So I know I'm secured at one rate, and I'm just hedging my bets that it's going to drop a little bit more. If not, then I will go with what I've got, because it's still better than the variable rate by about 3%.
You sound like Martin Lewis off the program last night. He was saying about the holidays. He said book them, and he said, and if the price changes, check at the last minute because you might be able to rebook it and cancel your earlier booking if you got free cancellation and get the holiday for even cheaper or the car hire for even cheaper. It's the same kind of concept.
It
You know,
is, yeah, yeah, I did
apply
see
for a
that.
mortgage now, and that's your worst case scenario. And when you
Yeah,
actually need it right at the last minute, just get your broker to double check that the rates haven't changed right at the last minute. Ah, good.
yeah. So
Nice.
no, it's, I didn't see that, but yes, absolutely right. Because I'm thinking three mortgages. I know what the values of those mortgages are over a 5 year period. If it reduces by 0.5%, then that's still going to be a lot of money. So it's looking at the detail. Uh, and as I was saying last week, there was a time when I haven't done that because of time, but I'm now focusing more on each buy to let to make sure that the pricing is correct, because that can you can be making rents increases, and I can't believe it at the moment. Rents are going up so much in this area, and we've fallen behind on the rents as well, and then people get trapped into their rental situation. Um, so yeah, trends emerging with positively supporting market activity in the coming months. Uh, my leaders of this new mortgages are coming to the market. That's basically the bottom line, the affordability of new mortgages coming to the market. And again, when Wayne is here, he may cover those bits. That that just shows that the lenders are more positive about the market, etc. Whilst the 5 year fixed, so my rate on this one, it says is around 4.5. I think it was about 5.5. I think I was looking at. So yeah, that's what my rates are at the moment on some of them, but that's the ones I'm looking at. Some of mine are with Aldermore and some are with Saffron and many other lenders. And that's the other point. I spread my lending across many lenders rather than it's the best deal on the day that we're looking for, aren't we? So best deal on the day um, gets the business. The stress levels, mortgage stress levels of 24, they've increased over a period of time, boosting pre-24 levels of 26 to 27. This would deliver a 15 to 20%. That's what they're boost the buying power. So again, it's the stress test that they're enhancing to make it easier for people to buy. Average first-time buyers, which is interesting, with mortgage repayments of £1,020. Apart from Rick, what do people feel? £1,000, is that good for somebody starting out on a first-time mortgage? Going once,
I
going
don't think that's
twice.
too bad, to be honest, because a lot of youngsters now, certainly my daughter, her mortgage is massive. Um,
Yeah, did you want to, Paul? I think I can't hardly hear you. Maybe that's it.
yeah, I'm not sure if this mic's working properly. To be fair,
Yeah,
yeah, I think £1,000 not too bad to be fair. So I certainly from where we live around Thurrock area in Essex, it's to buy a property around here is quite expensive, and the mortgage payments they're even extending them to 30 years now so that they can get the mortgages down. Um, so £1,000, I wouldn't say that massive in a sense from certainly from this area
no,
for a first time buyer.
yeah, and they're stress
I'd
test.
agree. I'd agree with Paul there. Here in the Midlands, I was looking to purchase a property a few years ago, just over a year ago, and it was looking around the 1,300 mark. Just so £1,000 isn't too bad here in the Midlands as well.
Maybe Dan and Dan finished. Dan's about half six or so.
Whereabouts in the Midlands are you?
Uh, I'm based in Birmingham.
Okay,
I'm in
yeah,
Birmingham.
no, that's brilliant. Thanks for joining in this evening. So it's £1,500, 1,550 is their stress test level. So they've got to be earning pretty good money, but uh, rents in this area in the south, £1,000 for a one bedroom nowadays. So it's not, if they're getting a 3 bedroom property or something, then that's pretty good, isn't it? Just,
I think going back to the buy-to-let mortgage, just jumping back, because I'm just renewing one of mine at the moment. I've got another two coming up, but and Wayne, I think he's got me something like 3.83% at the moment, and that was a couple of weeks ago, and I've just done exactly what you just I think Rick was saying. You go back to him now. This is 2, 3, and then I've got 2 or 3 people looking at it to go back and see whether that's come down already, because I think it will have by the time I'm due to get it by the end of June. But the thing is, with the 3.83%, there is also a £4,000 admin fee, and that's the trouble to get the fee down. But when you look at the overall cost over the 5-year period, because there's that column in there, your total spend for 5 years, including your admin fee, it still works out the overall cost for the 5 years cheaper. You just got to pay that admin fee up front, and that's the bit that hurts, basically.
Yeah, in a lot of cases, Paul, you can add that to the loan, and it's 6 of this and half a dozen of the other, isn't it? You pay for it one way or the other.
Yeah, that's right.
So
I think
over
if
the
you add it to the
life,
loan, if you
yeah,
add it to the loan, it's going to increase your monthly payment. So it's
exactly. You either get cheaper monthly payments, but you've got to, when you move it again, you've got to pay down more debt, or you pay slightly higher payments. So I was just going to add that actually, and some of the ones that I'm looking at the moment, that's one big trend that I've noticed at the moment with conversation with the broker is a lot of the products that are coming to the market that are middle rates that are quite enticing. They're coming with a lot of no fees and no valuations, so there's not a lot of additional charges. So just make sure you are looking at the overall cost over the 2 or the 5-year period for whatever you're doing. And I'm taking one at the moment on one particular property, because I may or may not choose to sell it or pull out a load of the equity at some point. I'm locking it into just a 2-year fixed because it's got very low early redemption penalties of only 1%. So if I do want to sell it or remortgage it onto something else and pull out some more money, it's not too much of a sting if I want to do that. So it just keeps the options open a bit.
I think the relevant thing about the £1,000 a month really on an interest only mortgage is how much money does that actually get you, and in the current rates it gets you about £250,000. It's circa £1,100 a month on an interest only, and I think that's the number that really matters, is what's the spend rather than what's the monthly outgo and what's the spend. So that gets you about a £250,000 mortgage on interest only, and obviously a substantially less amount of money if it's a repayment mortgage. So I think it's the relevant number is what does your £1,000 a month get you?
Yeah.
Paul, you definitely wouldn't be getting a £250,000 rental property for £1,000 a month. That's for sure. It just wouldn't work for the investor. So you're getting a lot more property for the money invested if you're buying in that respect. Yeah. So. But yeah, Sunil said, rents are very strong at the moment. So if first time buyers can get on the ladder at £1,000 a month, I think that's not a bad deal at the moment, to be fair.
Yeah, no, brilliant. So thank you. The stress testing is being relaxed to 6.5. This is what Zubla is saying, which is great because lenders must have confidence in the market if they're reducing their stress testing. So that gives an indication on it. Wayne. So yeah, Wayne is in the room, so maybe he could pick up on that later. That stress testing is being relaxed, which means that there's more power to more money for somebody to go and spend. So that's excellent news. Just to go on to the mortgage part again, if you're going back to your original lender and asking them to look at their products, they may not charge a product fee, and there's certainly no transfer fee. So there is a saving to be had there, just to remain with the same lender, of course. And some people don't go to the same lender; they go, "Oh yeah, what's the best rate?" and they'll move away from that lender. But of course, there are fees attached to that. Maybe broker fees. There may be there's definitely solicitors fees. There's new product fee, as Paul is mentioned as well.
Right, Sunil. Let's just hope that the inflation rate is not going to go any higher, because the figures out today was at 3.5%. So I hope that that is not a sign of things to come.
Yeah, Cameron, definitely, because we like inflation on one hand because it increases property prices, but on the other hand, of course, interest rates go up, and it's not a great situation in that respect. So yeah, I agree with you, Cameron, that hopefully things will keep moving forward, because if there's confidence in the market, again, we can all make money from the market. We can make money from our own skills, etc. Paul, did you want to come in there on what I just said there? You can do.
You have a lot of Pauls. Which Paul are you talking to?
Mr. Marriott.
Thank you. Just call me sir. That'll do fine. uh, I think these things are always interesting. When you look at the total market and you kind of, you're moving to the north-south divide. But I think one of the things that you've got to keep in mind whenever you look at this sort of thing is, I always say that there's not a UK property market. There's UK property markets. So, there's the Scottish market, which is very strong at the moment. I mean, where we are at the moment, looking at valuations and prices, there was a property went up for sale for less than 7 days, just not far away from us, with a surveyor's value of 630, with 10 offers that went in for it, which is quite usual for this area, 8-10 offers, and sold for 780. So we're still seeing a very strong market at the moment, and that's a supply and demand issue. There's very little supply and there's a lot of demand. So I've always said there's no such thing as the UK property market. There's UK property markets. So there's Scotland, England, Ireland, Wales. And then when you look at England, there's the north of England, there's the south of England, and then there's London. So there's 3 markets in London and England alone. And they're the macro markets, and then you get the micro markets inside of that. So we live in a beautiful little village where there's only houses come up on a very rare occasion, and I would say there's at least 10 buyers for each house. So you get that micro market effect, whereas you go to a big city, right, and there's more supply than there is demand. So while I always find these general kind of overviews from people like Rightmove and Zoopla and EIG, which is the auction website, which is a good one as well for kind of an overall view, give an overall view every month. I think you've got to remember that it gives you a big picture, but it actually has very little to do with what you're doing on a day-to-day basis, because very few of us are working right across the country on a regular basis. We tend to work in certain areas, and these overall view numbers don't really affect our areas. So there's the UK markets as opposed to market. Then there's the macro markets, England, Ireland, Scotland, Wales. And then there's the micro markets, which is the town or the village or the city that you're actually working in or working around. And whilst I find these things interesting to look at overall trends, so we've seen there that the overall trend in the UK was that properties have went up by 1.6. But Glasgow last year went up by 8%, and Edinburgh went up by 12%. To give you a Scottish view on that. And yet, if we look at certain areas of London, they're actually currently running at a negative as opposed to a 1.6. So it's that 1.6 is a delusional number. You really have to understand what's happening in the market that you're in. And I think rather than looking at this overview of the country, which is interesting, but no more than that, you look at what actually drives prices up. And if you've got some time somewhere in the presentation, I'll quite happily talk about what's kind of what I find drives prices up in a local area once we look at the overall view.
Yeah, that's brilliant, Paul. Thank you. So we're seeing growth in Kent due to London market being very strong, or London prices being, people being priced out. And after lockdown, people have moved this way. And we've seen a big trend of London buyers coming into Sittingbourne and various towns in, they started on the M2 and worked their way down. And that, that's across the board, because they can't afford to buy in London, or they may sell in London, get better here, and there's still a direct link into central Victoria and they can still work from home. So schools, etc., are all good. So there is that. Number of sales agreed is also higher than a year ago, which is what they said before. Sales agreed is double digits in Wales and Northwest, Northeast. So they're saying, yeah, that's where the growth areas, or more sales, more transactions. I think that's the point. There's more transactions in those areas. So Cameron just mentioned price increases, and this is the Southeast, etc. House prices inflation is still setting at least 1% across the Southeast, and where affordability pressures are great. So yeah, people can't afford to buy houses, or what they are buying is limited, or it's the bank of mum and dad where they have to invest money or have bigger deposits to be able to purchase in this area. But it's good that they do purchase, because the rents are so much. Is prices are raised between 2 to 3% across West Midlands. I think our friend in Birmingham, I'm sure he'll confirm that there is good growth in Scotland. But I mean, Paul, you just said that Scotland was a lot more than that, didn't you?
No, I didn't say Scotland, and this is that macro and micro market, right? I said that that Glasgow and Edinburgh and Stirling have seen a very strong increase.
Yeah. Okay.
I would say across Scotland, if we were doing a thumbnail across Scotland, I would say we're probably looking at about 5% as the average. I wouldn't agree with that number at all, right?
Yeah.
And then you've got the outliers.
Yeah.
Which are the ones that are hitting that kind of 8, 10, 12% for varying reasons. And they all have a reason for doing it. And I think that's what these overviews never give you is, I always say about things like this is history. So we're reading history at the moment, right? Mm-hmm. And it's very difficult to make money out of history.
Yeah.
You want to make money out of the future. So what rose by 8% last year isn't necessarily going to raise by X% this year.
Yeah.
Right. And it's knowing those factors that are likely to raise our prices. So I've never made any money out of history, but I've made an awful lot of money out of following politics and working out what's going to raise prices in an area. And that's why this is interesting more than it is useful.
Well, we expect market activities to continue. They're saying the same as last year, so lower growth, more sales. Growth is good. So this is the message that they're promoting, that growth is good. There is demand. There are more sales being agreed. So that's good, and they can see all those things coming through. They can see the number of properties being listed, the number of viewings, the number of sales agreed, the number of days that property has been on the market. They've got a lot of data on there. So yeah, it just continues to increase the market. Let me just move forward to some of the tips. So yeah, this is the trend is more buyers are looking to move. Maybe they think it's the right time now with interest rates dropping, etc. That they feel it's the right time to move now. And Paul's already mentioned that the buyer.
I think, Sonny, the other factor that is fueling the demand is the rental market with the new legislation and landlords doing the due diligence in terms of the tenant selection. The landlords, I was having this conversation with one of the local agents this morning. He thought he had 7 deals in the bag, but none of them has been agreed with the landlords yet, the landlords of those properties. And because the landlords are not happy with the quality of the tenants presented to them. So with these tenants not being able to find those properties to rent, I think a lot of them, coupled with a relaxation in lending criteria, are going to go and buy their own places. Mm-hmm. And that in turn will fuel the demand mid to long term.
Mm-hmm. Yeah. Thank you, Cameron. Appreciate that. house prices inflation slows down as demand cools and supply expands. Well, yeah, is supply expanding? Yeah, I think more stock's coming to the market. That's what they're saying. Is there's more demand. There is more stock coming to the market. We have seen this. That there's more stock coming to the market, with some landlords selling up, and just thinking that this is the right time, as Cameron just said, with another law coming in around the corner with renters' rights bill, and we will continue through that. But some landlords think that, yeah, because of age, because of various factors, maybe this is the time to exit. We are in the market of selling that property with a tenant in there. So would speak to somebody like Wayne who'd get the mortgage, his team would get the mortgage for the new purchaser, and we would just keep the tenant and move that transaction so the landlord can retire and they get rent up until completion. And of course, the major benefit for the new purchaser is they get rent on day one with a tenant being in place. If you are going to purchase a property with a tenant, please feel free to get in contact with me, because there is a checklist to go through that your solicitor needs to go through. But before you make your offer, you should really make sure that there's certain things in place, because what you don't want to do is think that it's a great deal in terms of the purchase of the property and you're getting rent on day one. But if you get stuck with a tenant, that could be very costly, of course. So yeah, if you want to chat on that, then let me know and I can please. Yeah, I can't share the checklist here, but I'm happy to have a Zoom call with somebody and say, look, let's go through your personal circumstances. Let's look at what there is, and in some instances, we can bring Wayne in and say, look at the finances, but there's certain things that have to be in place, like the smoke alarm should have been checked on the day that the tenant moved in. EICR needs to be in place. Right to rent checks need to be in place. All of these things need to be in place. Otherwise, you may find it difficult to evict the tenant. So, if you ever need to get the property back, it keeps sending the message here that the price increase is 1.6 year to date to March. So yeah, there is still trends going up. Buyer demand 1% higher than last year. So I think somebody mentioned the stamp duty before, temporary and the stamp duty relief, seasonal factors and economic uncertainty. Is there economic uncertainty? Because on one hand, demand is going up. Mortgage companies are reducing their stress levels. So that's the positive part. But there are some uncertainties in the market as well. We don't know what's going to happen with the new law. There's economic in terms of, the world economic and local economy as well.
I was just going to say, Trump's trying to do a good job of that one, creating uncertainty in the marketplace.
Yeah.
So yeah, watch this space on that one.
Supply of houses.
That's exactly the type of thing I was talking about earlier on, about kind of looking at. So we've got this policy that we've had for a number of years called following politics, not prices. So looking at the politics and saying, so what is going to happen? So if you look at what's background noise? If you look at
British Transport,
just mute yourself.
See it sorted.
Okay, I think we're good there, Paul.
Okay, thank you. So if you look at the tariffs, for example, and you say, right, okay, and this is where you start to pull down into regions, and you say, right, okay, so how's that going to affect the house prices, and how's that going to affect rents? Well, if you take the 10% across the board on vehicles, for instance, right, and we're a huge exporter of Land Rover and Jaguar to America. And so Solihull, which is the major plant for producing Land Rover, right, that whole area, I mean, we used to be, just to give you an idea, what we used to pay on cars going into the US, we used to pay 2% tariff. That 2% tariff is now 10% tariff. That's going to put a heck of a lot of Americans off of buying a vehicle that's over $100,000, which is what a Land Rover is in the US. right? Because 10% is an awful lot on $100,000. So the sales are likely to drop to the US, and that's likely to affect the plant in Solihull. And if you've got properties in and around Solihull, you're probably going to feel that. Likewise, our current Prime Minister is in the process of doing a deal with Europe, as you know, in terms of fishing rights, and kindly giving away some of the fishing rights that we got back, right? And if you are in anywhere that's dependent on fishing, then their catches are going to go down, their revenue is going to go down, and that's going to affect your property prices. So that's why I say politics are much more important than following politics. National, local, and international politics is perhaps more important than Rightmove saying everything in the world's gone up by 1.6%.
Absolutely. The key takeaway for me is this slide here, and I'm just going to pass over to Wayne in a minute, that the stress testing of mortgages, affordability, lenders is much better. Yeah, and I don't know, Wayne, if you want to come in on that and say, is that the case that we are seeing relaxation on stress testing? And then you can go into some slides, but will you be able to bring your slides up?
Yeah, of course, buddy. Yeah, of course.
Yeah, if you want to carry on that point, then maybe that would be a good lead-in.
Allow multiple replace current share. Apologies, guys.
Allowed to share.
Sorry, guys, I was a little unprepared with the slide.
No, that's okay. Just come in when you can, and I'll just continue and fill in. So I was saying about doing checks earlier on. If you're buying a property with a tenant, which is a good idea, just make sure the paperwork is correct. Is you knowing what your solicitor is checking, or you're asking your solicitor to check certain things, because you just want to make sure that they've covered every angle for you in the event that you need to part with that tenant. We're also doing reviews on portfolios. So if you have a portfolio, it doesn't matter where you are in the country, we're happy to sit down over Zoom or something and look at your portfolio. As I say, we've got experts in the room. Paul's helping me a lot. Wayne's helped me a lot. So then we can look at those and say, okay, what can you do to maximize that portfolio, making sure that you're de-risked and you've got the best rates, you've got the best things. We do HMOs, but Rick's ex-HMO expert, so if we need any help, we can always call on him or other people to say, look, look at this and see how you would tweak it. So those little tweaks are going to be very key, because tweaking a little bit on every property, it really does add up. So whenever you're ready, Wayne. I don't know.
Yeah. So sorry, guys, I came in a bit late. I've been at a property auction up in the Midlands, and bad traffic on the way back. So you're mentioning stress tests. So stress tests on residential mortgages, presumably.
Yeah, I think the Rightmove information I've got is probably in general rather than specifically to buy to let, which is a good point.
Mm-hmm. So I think the stress test that you're referring to, I mean, when we saw kind of Trustgate, we saw interest rates rise very, very quickly, very, very, very steeply. And as a consequence to that, lenders implemented, the regulator suggested that lenders implement a stress test of effectively 8.5%. So on residential mortgages, saying, well, okay, well, let's stress test. Let's assume your mortgage could go up, and it could be near 8.5%. So when we're lending to you today, we want to see that your mortgage could be afforded to you if you're looking at a mortgage rate of 8.5%. Now, the reality is, for the last decade, we've not really seen rates at 8.5%. For the last probably 2 decades, we've not seen rates at 8.5%, other than maybe 1 or 2 months where we saw kind of 7% or there or thereabouts, maybe 3 months after September, October 2022, with the Liz Truss. So now what the regulator has said is actually, look, that 8.5% stress test is a little bit too high. You don't need to be stressing a mortgage or seeing someone's affordability at 8.5, but it's really limiting their ability to raise debt. And they've brought it back down to 6.5%. Now, it's no surprise, really. I mean, when you look at the amount of sub 4% residential mortgages that there are, I think there were something like 26, 26, I think it was, sub-residential mortgages in middle of March, beginning of April. I think there's now 156 or something. So it's a significant jump of sub 4% mortgages. So, when you think that's still a 2.5% buffer, yeah, I think it's a very strong move, and I can see exactly why they've done it.
Thank you.
Yeah. In terms of a market update, I think everybody on here knows who I am, but if you don't, my name's Wayne Gray. I'm the Managing Director and owner of DMI Finance. We're a commercial mortgage brokerage assisting investors, effectively, guys, whatever form of finance you want as an investor, we can assist you with. Some slight overlap from those of you that saw me in the room last week or the week prior. Last week, wasn't it?
Yeah.
But for those of you that weren't, I guess most obvious point is that we did see the Bank of England base rate reduce. So on the 7th of May, the Bank of England reduced the Bank of England base rate from 4.5 by 0.25% to 4.25%. Interestingly, guys, it was a split decision. There are 9 members of the MPC. You always have a couple that perhaps are a little bit more firm on things than others. 5 voted to decrease the Bank of England base rate by 0.25%. 2 voted to decrease by 0.5%, and 2 voted for it to remain. Now, when you look at the minutes of the meeting, they were really talking about gradual further cuts likely ahead. I can't remember; it's not verbatim, but there were certainly murmurs, suggestions of more gradual cuts later this year. That said, guys, I think Cameron mentioned it earlier today. Today we've seen, and last week I was talking about March's inflation figures. Now we're seeing April's inflation figure, and it has shot up. One thing I would say is that, if you look at where inflation has been, discounting the trend previously was for it to be reducing. What was it? 2.8 was the forecast for February, and it came in at 2.7. 2.7 was the forecast for March, and it came in at 2.6. They are on the money, relatively speaking, with that forecast. The forecast was and has been for some months for inflation to increase. It's not a shock increase to 3.5%. It was certainly expected, and it's certainly expected to stay a little bit higher for a good period of time. The markets were predicting it to come in at 3.4%. So again, for the last 3 consecutive inflation data releases, we've only been off by 0.1, albeit it's higher now and it's 0.1 increase rather than 0.1 decrease, but we're not too far off the mark from the forecast that was there at 3.4%. The markets were predicting another base rate cut in a couple of months. So the next time they meet, I think, is towards the latter part of June, or maybe early July. And then again in August, markets were predicting a base rate cut in August. I saw this morning when I looked before inflation, it was forecast that we might see, or there was a 60% likelihood that we'd see an August reduction. That went down to a 40% likelihood. But guys, I mean, it's way too early to tell, and things are incredibly fluid. The reality is, I'm sure we'll see further rate reductions this year, perhaps August. Pricing, guys. Rick mentioned it just a minute ago about 2-year and 5-year Rick, the decision to take a 2-year fixed may have been hindered previously because 2-year borrowing was fractionally more expensive than 5-year pricing. Now, those rates are almost identical. The average rate on a 2-year and a 5-year, they pretty much converged. And now you're probably talking, subtle 0.1 difference between the two. Of course, notwithstanding that every lender will have their own rates and every loan to value parameters, the differences within it. But 2-year deals are now back in the spotlight, given that the rate that we're receiving on 2 years is largely just as competitive as we're receiving on a 5-year. Why? Well, guys, it's swap rates. If you look, cost of borrowing and swap rates, guys, for those of you that don't know, is effectively the underlying rates at which banks switch variable rate pricing for fixed rate pricing. It's the rates at which the banks secure the money that they're lending to you on a fixed rate, high level. If you look at the difference between a 2-year and a 5-year, on the presentation there, it's pretty negligible. So you can see what's given them the opportunity to reduce their 2-year costs. In terms of recent lender rate movements, guys, largely speaking, as has been the case for the last 2, 3, 4, 5 months, rates are going down. We have, however, seen a couple of lenders increase their rates. Keystone have increased their rates slightly. And in fact, TSP on the residential side increased their rates slightly last week. But rates are still going down from other lenders. Aldermore reduced their rates by 0.3%, pretty strong move. Bland Bay reduced their rates on their entire product range by up to 0.8%. And that was yesterday too. Pretty significant reductions. Yesterday also we saw Vita Home Loans reduce their rates by 0.1%. And of course, last week we saw Keystone increase their rates. In terms of criteria movement, guys, what have we seen? Probably not breakthrough. I don't know whether any of you would have ever heard of Moda Mortgages or used them. They're a new lender. They're owned by Chetwood Financial, who are the parent of CHL Mortgages, who are a much more well-known brand. They're a brand back in kind of 2006, 2007, and then disappeared for 14 years and then came back to the market in 2021. But Moda Mortgages, their sister company, are now willing to entertain refinances at the open market value of a property within the first 6 months, where a property has been acquired on a bridge. Not breakthrough. Lots of lenders will do it. But good to see another competitor entering that space. And then, guys, Mint Bridging have launched a 90% day one bridging product. So what this is, guys, is on the premise that you're enhancing the value. So what Mint are saying is they're saying, okay, we'll get our valuer to go out, we'll value it now. We'll look at your schedule of works and he'll value it after works. And so long as your day one purchase, or so long as what we're lending is no more than 75% of the gross development value, the end value, once you've done the works, we can consider lending 90% of the purchase. Pretty attractive, guys. No minimum term. So, if it's a flip and you're certain you're going to get out of it very, very quickly, then they'll lend and they'll allow you to service the debt or retain the payments over a far shorter period of time. It's available on houses and flats, albeit they want them to be curbside, guys. So we're talking about properties, in towns and central locations rather than in the countryside. All types of borrowers considered, including those with very heavy adverse, if the intention is to sell the asset. The key, guys, as with any form of bridging finance, is exit, exit, exit. Can we sell that asset? Can we repay, how are you repaying the debt? In terms of key dates for your diary, well, as we say, we had ONS release the CPI inflation data today. The next release will be on the 18th of June. And we'll have the next Bank of England Monetary Policy Committee meet, where they'll decide on whether they're going to increase, decrease, or keep static the Bank of England base rate. That's on the 19th of June. In terms of headline rates, guys, and I will always say, you don't look at these as a representation. I heard Paul and Rick talking about rates earlier. I say it every time, guys. It's very much a smoke and mirrors game with lenders where they're offering you a very, very modest interest rate. You can be absolutely certain that the arrangement fee on the back end will be far less modest. It really is, as Paul said, looking at that total amount payable column. If you're working with a broker, ask them to say, what's it really truly going to cost me? Cash flow is important, of course, but what you really want to know is taking into account any valuation fee, any arrangement fee, any associated fees that mortgage lender are charging, taking into all of those into account and looking at that total amount payable. Because the reality is, guys, there's no such thing as a free lunch. If they're giving you it in one hand, they'll be taking away in another. But if you look at those rates, the headline rates, same kind of color coding as normal, guys. Those in green or bluey have gone down. Those in black remain the same, and those in red have gone up. Nothing has gone up in terms of headline rates, and this is really just, guys, to give you an idea of the general trajectory of rates. If we're constantly seeing blues, then we can see where the market's heading. If we're constantly seeing red or black, then we can see a different sign. But generally speaking, month on month, rates are coming down, and where headline rates are, the rest of the market will follow. That's pretty much it for me, but I'm more than happy to answer any questions if anybody has any. If you do want to subscribe to our weekly newsletter, guys, where we give lots of news about mortgages, the economy, auctions, and lots of other property-related nuggets, then by all means follow the QR code and register. But that's it from me.
Brilliant. Thank you, Wayne.
Thanks, buddy.
Questions, please feel free to unmute and ask questions of Wayne, or general questions that we can help with.
Wayne, just a quick question. Is there a minimum loan amount that you have to borrow with a bridging loan? You mentioned like 90%.
On that 90%, technically, I think it's 75k something, but we have a good relationship with Mint, and by exception, they'll go down to 50. The reality is every lender, just like a normal mortgage, every lender has a different criteria. I've got bridging lenders who will lend you on a 20 grand borrowing. They wouldn't lend you 90%. They might be at 70, 75. But yeah, I mean, in theory, there's no minimum loan size with the right lender. But on the Mint product specifically, technically it's 75k. But they've told us that by exception, for the right deal, they'll go down to a 50k loan.
Cheers, thank you.
No problem.
Bigger reminder you're looking for?
I'm just keeping the options open at the moment. I'm cash buyer, so I'm okay at the moment, but it's just if I need to do bridging later on.
Yeah.
Yeah.
No, it's a good question, because normally people are going, how much maximum can I get? But it's the other way, so yeah, it's a good question. General questions from anybody or specific questions, we're quite happy to take. So if anybody wants to take advantage of the room, then please feel free to unmute and ask a question.
Yeah, just a quick one, Wayne. I know you're looking at something for myself, but I tend to look at the 5-year deals.
Mm-hmm.
Looking at your figures there, the 2-year deals are almost at 1% below. Are the fees still, for your lower percentages on your mortgage, on your 2-year deals, are they still
Yes.
fees?
Yeah, I mean, it's Paul, I think, and I know Rick made a really good comment earlier where he said he's taken a 2-year fixed rate because he doesn't want to cap raise fully against the property now, and because there's equity in the property, he just wants to keep that ability to draw that money down at a later point. The reality is, in the vast majority of instances, I think it's a false economy not taking a 5-year fixed. The fees will be high, and if they're not high, the rate will be high. As I say, it is well and truly a smoke and mirrors game with the lenders. And what you get, if it is that you are effectively crystallizing the gain. If you're saying, well, I'm borrowing 75% of the £150,000 value now, and I'm leveraging against that asset, what's the gain in 2 years' time? The gain in 2 years' time is interest rates have dropped, and you can secure a better interest rate. But to get that better interest rate, you've got the associated costs. So yes, the interest rate might drop, but the arrangement fees will still be there. You still have the valuation fees, you still have solicitors' fees, you still have broker fees. And what you're doing on a 2 year, effectively, you're replicating those costs 2.25, 2.5 times, if you take 2 year, 2 year, 2 year, over that 5 year period. In my mind, it's a false economy for any situation other than the situation that Rick's talking about there, where you've got equity in the property, or indeed you intend to sell it, that you may want the ability to draw down at a later point. But no, the arrangement fees will be high on a 2 year, just as they will on a 5. Without being too long-winded, the other thing with a 2 year, Sarah was mentioning stress tests, and the way that buy-to-let lenders work is they implement stress tests, not the 6.5 or the 8.5 that we're talking about before, but the stress test that buy-to-let lenders will implement is that they want to see that the rent perhaps covers 125% of a figure. Now, if you take a 5 year fixed, that figure can be the interest rate that you pay. If you take a 2 year fixed or a 2 year tracker or anything short of a 5 year fixed, that won't be the interest rate that you pay. It'll be the interest rate that you pay plus a margin. And that margin might be 1.5 to 2%. So just to put that into perspective, and I don't want to lose people here, but if you assume that £1,000 rent, if we say it has to cover, we've got an interest rate of 5%, we've got a 2 year fixed rate and a 5 year, both costing us 5%. £1,000 rent at 125% on a 5 year fixed could get us a loan of £192,000. If we say that the same £1,000 rent, the same interest rate, 5%, but we're actually securing 5% on a 2 year fixed, because they won't be stressing it at 5%, the lender will be implementing an increased stress test, perhaps 2% above, so 7%. That same £1,000 rent will now achieve a loan of £137,000. So certainly in your areas where, as Paul says, speaking nationally, yields might be lower, values might be higher. It may well be, if you're looking to capital raise, you can't take a 2 year rate even if you wanted to.
Yeah, okay. Yeah, you kind of fixed. Yeah, I'm always a 5 year fit person personally, but I was just interested, and you kind of sold it.
Yeah. Look, I'd be more than happy to get the team to give you, here are the best 2 years, here are the best 5, and perhaps extend the 2 over a 60 months to see what the actual true difference is. But I would say that in many instances it's a false economy.
The only kind of exception to that rule, I think, Wayne, was what someone was speaking about earlier on, and my clients, one of my clients is doing this at the moment in terms of, I act as a business consultant, and one of my clients is looking at buying a couple of properties, but he, for varying reasons, will be able to either self-finance them within a year and a half, or he'll choose to sell them within a year and a half. So the exit fees are very important to him.
Yes.
And on the 2 years loans, the exit fees are substantially cheaper than they are on the 5 year ones. So you're kind of looking at like 2% in the first year, 1 to 1.5% in the second year on a 2 year, but you're looking at 3% down to 2%. Yeah. So if you're looking at exiting quite quickly or paying the property off, either of those, then you want to look at the 2 year, because, well, do you gain more on the roundabouts than you do on the swings, because the exit will be the exit fee will be a lot cheaper.
You're right. I think exit or capital raise, if you are crystallizing a gain on a property that you intend to keep, then 5 year all the way. But you're absolutely right, Paul. I completely agree.
Great. Wayne, thank
because
you
he's
so
doing
much.
it. He's doing it on properties at substantial amounts of money. £750,000. So
Yeah.
and borrowing quite a substantial amount, but looking to pay it back relatively quickly. So that difference between 1% and 2% is for him an awful lot of money.
Significant. Yeah. Yeah, no, absolutely.
Yeah,
Oh.
Foundation Home. They had a product. Is a 5-year fixed product with a 3-year ERC, and I think that's the best of both worlds. The only drawback with that is that the interest rate is slightly higher than the ones that you just published there. You just showed us, Wayne.
Yeah, I think, but as you'll know, the reason they do it is, as you say, to get the best of both worlds. It gives you the stress test based on a 5-year fix, so we can borrow more, but it's on a property that we don't want to be tied in for 5 years, that we may want to sell or re-leverage against in 3 years. It's a great product. I wish more lenders. Avida came out with something similar, and Godiva back in the day used to offer something similar. But yeah, I wish more lenders were a little bit more novel in their approach and offered something similar.
Yeah, thank you, Cameron. Appreciate that. Wayne, could you put your last slide back up again? Because I've had a request to say they just want to see your QR code come up, please.
Of course.
So this, but finally,
Is that it?
yeah, just need to go to the end slide, please.
Yeah. Am I right?
Okay, so what can we do for you? That's the question, isn't it? So I think, Wayne, if you just move down to the fourth slide. So what can we do for you? Happy to do free reviews for you in terms of your portfolio, compliance checks, because there's a lot of information that is required for tenancies. Yeah, it's so much more complicated, and it's getting more and more complicated. But we're here every day. We have a whole team of 12 people now, and their whole objective is to help landlords, making sure that they're compliant. That we do compliance checks, we can do financial checks, portfolio reviews. As Paul mentioned earlier, we work together. He's a consultant that's come into our business over the last year, helped me tremendously, and we can tap into various resources like with him and with Wayne. And he does charge, by the way. He's not going to do that for free, but I'm just saying that there are lots of resources on here that can come in to help your business grow. Review. Yes, there's a lot of information in terms of what the market is, but it's about reviewing your portfolio as often and as much as you can. So we can do all those things for you. There is one request I have for you that you could help me with, if that's okay. I'm looking to expand our trading business, as in our lettings business, especially in the southeast. But it doesn't matter where it is. It could be in Birmingham. It could be in Stoke-on-Trent. We have properties in Stoke-on-Trent. So we are looking to buy letting agencies or the book. We not necessarily want the premises, but it could be the book. We've done one last year. It was very good. We paid them a lump sum at the beginning and then on a monthly basis, and they handed us all the files, all the clients, all the tenants, and then we've amalgamated that into family homes. So we find that, yes, I can go and look for one landlord at a time, but acquisition, we know that is the key. So you may come across somebody that your letting agent, wherever you are, may be retiring, they may have personal issues, etc., and they may need some help, and they may be looking to exit their business. And I'm in the market at the moment to talk to those people. So, yeah, if you could help me with that, and if there's anything you need, you know where we are. Any final questions? Paul, any final thoughts from you?
I was just going to cover a couple of minutes, to be honest with you, because we can, if people are minded, we can kind of cover this in depth another one of the sessions. But I think we talked about house prices, and we talked about kind of what makes house prices what they are, right? And I just wanted to cover some of the things that we've really focused on over the years. And just to give you a little bit of background, I've been in business for over 40 years. I've been in property for 30 years, and we've built up a debt-free portfolio of both commercial and residential properties. We're also a developer of commercial and residential properties. And to give you an indication of kind of where we are at the moment after that long slog for 30 years, we've got 3 developments on the cards at the moment. One's 52 million, one's 22 million, and one's 17 million. So that's where we are in the food chain, if you like, after a lot of hard graft and some grey hair, as you can see. Right. I think it comes with a property job, doesn't it, John, the grey hair? What's really worked for us is not following prices, not going and looking at what happened last year, but looking at what's happening next year, right? So what's happening in areas that you could take advantage of. And when I say areas, I think it's always good to think outside of whichever box you've put yourself in. And most people put themselves in a regional box. Does that make sense? Right. And it's always good to think outside of that regional box, because for whatever reason, that regional box might not be the best time to work, to buy, to sell, to trade, to rent in that regional box. Is that making sense to everybody? Despite the fact that's your regional box, that might not be the best box for you at this point in time. So we started with £40,000, and I looked at what £40,000 could buy where I lived, and it wasn't very much. So I looked outside of where I lived, and within three and a half years, we'd built up over £1 million. Our first 3.5 years, all those years ago, we'd built up over £1 million with a debt-free property, because I was willing to step outside of that regional box that made me comfortable. Yeah. So what did I look for when I went outside of that regional box? Right. What did I think was going to make me money tomorrow rather than yesterday? Number 1, road or rail links. If you find somewhere where there's new road links or new rail links going in, there's always houses follow. So I'll give you a brief example of that. It'll take me literally 2 minutes. We bought some fields where there wasn't a new rail link going in, but what they were doing is, it was a commuting village, and what they were doing is they were taking the trains from every 2 hours to every half hour into the city. And we bought some fields. And within 2 years, we had 10 times what we paid for those fields without even putting planning consent on them, right? Because there was no new rail link going in, but because they had made that a commuting village by taking it every half hour rather than every 2 hours, then a lot of people thought, I can go out there, I can buy a nice house, and I can commute in. Work, obviously. I always look out for new employers, particularly major employers in an area. So one of the buzzwords in the last 10 years has been Amazon. Where's the next Amazon depot? Because you can guarantee where the next Amazon depot is, right? There's going to be a lot of work. And where there's a lot of work, there's going to be a need for housing. Now, there is a value, there's a top point on that. You're not going to sell £2 million houses because they built an Amazon base, but you will rent out what I call bread and butter homes. Does that make sense? So we've talked about road links, we've talked about rail links, we've talked about work, schools and hospitals. So there's a village not far away from us that was always a dead end village, if you like, right? It didn't have great rail links, it didn't have great road links, and it didn't have a big employer. But they have recently built a state-of-the-art school. And in the last 2 years, the results from that school are wonderful. So to give you an example of what this can mean in pounds, shillings and pence, there was a house come on the market the year, 2.5 years ago, before they opened the school, because they opened the school 2 years ago, and it was on and sold for £250,000. That house has just came back to the market and it's on for 380, and it's likely to sell 20% over. That's what a good school can do in an area. So just a little bit of expanding thinking, because I know in property we can all be a bit guilty of our doorstep. Yeah, anybody been a bit guilty of our doorstep? right? But believe me, there are doorsteps right now that are a lot more profitable than yours. And there's no reason why you shouldn't be there. And I'm going to finish with something that brought me into property 30 years ago. I was walking down a road, and it was one of those roads, it was a really long road. It went for miles, because I used to walk for miles. And it had everything on it. You know, it started off in a city, and then it went out into the countryside, this road. And it had residential property, it had commercial property, it had industrial property, and it had agricultural property. And I'm walking down that road about 30 years ago, and I thought, somebody's making money out of all of this property, not just the commercial property, not just the residential property, not just the industrial property, and not just the agricultural property, but all of it. And I asked myself a key question that has helped a huge amount build that debt-free portfolio worth millions that we have now. Why shouldn't that somebody that's making money out of all of those different types of property, why shouldn't that be me? There's a hell of a question, isn't it? So that's my thoughts for the evening. Sunil.
Thank you. Appreciate that, Paul. Yeah, great thoughts. Why shouldn't that be me? So take that away, and I'm sure you've got some other takeaways. Look, reach out to us if you need anything. And yeah, we're happy to help wherever we can. So thank you. Is there any final? No, I don't think there's any final questions, so I'll call it a day. And I wish you a lot of luck, and we'll see you very, very soon somewhere. We're on Clubhouse on Friday morning, 7:30, and again on 7:30 on Monday morning. And if not, we'll see you on the next Zoom or in-person room. So, yeah, happy investing. Have a great evening. Thank you, Paul. Thank you, Wayne. Thank you, everyone, for joining us. See you later.
Thanks very much. Cheers all. Have a good evening.